Namaskaram. So let us continue with transfer pricing provision. So far we have discussed section 92, which is the charging section of transfer pricing, which gives a parameter. Section 92 says if there is an associate enterprise which has entered into international transaction or specified domestic transaction, then that particular method, please understand, there is an associate enterprise has entered into international transaction or specified domestic transaction, then the transaction has to be at arm's length price. What is associate enterprise? We have learned in section 92A. What is international transaction? We have learned in section 92B. What do you mean by specified domestic transaction? We have learned in 92BA. Now in section 92C, read with rule 10B, we are going to learn what do you mean by arm's length price. My dear friend, arm's length price should be computed for international transaction, also for specified domestic transaction, and that would be determined with any of the most appropriate method having regard to nature of transaction, class of transaction of associate persons. So let's see what are the methods which are prescribed so far. The most used and most targeted method in examination is comparable uncontrolled price method, also known as CUP method. We call it CUP method, okay, CUP. So comparable uncontrolled price method in practical life, theoretical life, exam oriented, this is the most utilized method. If they target 100 questions, out of this at least 80-85 questions will be from comparable uncontrolled price method. So you have to study this method little deeply, and that is very much reasonable. Comparable uncontrolled price method means if you have done two transactions from India, you have done two transactions, one transaction with related party and one transaction with unrelated party. So the transaction with related party will be ignored and your price will be compared with transaction with unrelated party, and then whatever is more favorable for income tax department, that will be taken care. So we will discuss that. Okay, comparable uncontrolled price method. Then there is another method called RP method, resale price method. Then there is a method called CP method, cost plus method. Okay, cost plus method. So CUP, RP, CP. So resale price method, cost plus method. Then there is a method called profit split method. Then transaction net margin method, PS method, TNM method. Okay, TNM method. And lastly, internationally we are having only 5 methods, but government of India, they will always try to bring something new from their side. So they said, okay, these are the 5 methods which are already there through the section, but we have to have a generic power from the section through which we can introduce a new method into whole computational mechanism. So they have this particular power. By using the power, they have introduced one rule through which we have to learn 6 methods. Okay sir, we have learned the 6 method. What if according to comparable uncontrolled price method, the price of transaction is coming to 300, a fair market value is coming 300. I have done transaction in 100 rupees, but the fair market value is coming 300. According to resale price method, fair market value is coming as 250. According to cost plus method, transaction value is coming 280. What if in exam they have provided me 3 different method and 3 different data? Which method I should follow? So that was written in section 92C. Whenever there are multiple data, you may get confused with these numbers and you may try to go for whichever is higher or whichever is lower, or you may do the average. So you should do neither of this. Okay, neither 300 rupees, not 250 rupees, not 280 rupees. There is no specific rule for this. You have to follow on most specific method or most appropriate method, most logical method. So how do you come to know about most appropriate method, most applicable method in your case? Obviously, people who are into that business, they know which method is most relevant method because they are into that business. Their competitors are also in that business. And income tax department will also come to know about that because income tax is not doing the computational for one particular assessee. They are doing computation for so many assessees. And now the artificial intelligence division of income tax department is also evolving day by day. So they have hundreds of thousands of data, comparable transaction in the system, that they know which method has to be adopted for particular type of industry or particular type of assessee. So most appropriate method has to be followed. No average, no higher, no lower. Please remember that. And what is most appropriate, that will be determined by the situation given in the exam. out of the above method has to be applied for determination of arm's length price in a prescribed manner. Okay, I'm not answering one question here. So what if in one method they have given the multiple numbers? Okay, for that we have range concept and all. We will discuss that in like in coming slides. Provided that where more than one price is determined by the most appropriate method. Okay, so we are applying cup method only. Through cup method we are having lot of data like 1, 2, 3, 4, 5, 6. Okay, there are 6 data given in that particular series: 200, 220, 230, 240, 280, 300. You have done the 6 transactions which are comparable with your transaction, and you have done the related party transaction for 100 rupees. Now 100 rupees is definitely not acceptable. Now we have to take one of this particular number. So which one number you should take? Obviously, when I told you if there are multiple methods, we have to follow the most appropriate. Sir, we have followed the most appropriate. By following the most appropriate, we are getting a lot of data, sir. Now what should I do? If data is up to 6, please understand, smartly I have taken 6. If data is up to 6, we have to take average. So you will take simply average, that will become your average arm's length price, and then you will take whatever you compare with your transaction value, and then you will provide the effect. But sir, please understand, if data is more than 6, then you have to jump to the rule 10CA, where we will apply mode and median concept. According to that, we will determine the arm's length price. That we will learn in rule 10CA, which is a separate lecture. So provided that where more than one price is determined by most appropriate method, the arm's length price in relation to the international transaction or specific domestic transaction shall be computed in a prescribed manner. Provided also that if there is a variation between arm's length price so determined and price at which international transaction or specified transaction has been actually undertaken. Please understand, this is called as a tolerable margin. Tolerable margin means Government of India says, okay, you have done the transaction at 100 rupees and arm's length price comes to 101. So the difference is only 1%. Please understand, the difference is only hardly 1%, or 102 2% or 103 3%. If difference is only 3%, up to 3% of the original value, then we have to give some tolerance, because depending upon the market circumstances, depending upon the current we have computed arm's length price in last month, and current month there are some demand and supply factors have changed, currency conversion ratio has changed, something has happened. Okay, and due to which obviously 1% or 2% variation can come. So we always say, for wholesale market, the margin which is tolerable by the income tax department is 1%, and for for retail or for in the absence of anything, by default you have to follow 3%. If they specifically mention wholesale in exam, then only have to think about 1%. Usually they also provide, whenever only once this question was targeted in exam in past, they usually say whether tolerable margin is 1% or 3%. That they will define in the exam. So for just for 1% or 2%, you should not activate transfer pricing mechanism. You should give up the SSC. So what you can say, this tolerable margin is an exit route. This is the first exit route that you are learning, okay, from the transfer pricing provisions. Okay, provided that if the variation between arm's length price so determined and price at which international transaction has happened does not exceed 1% of the later, that is 1% of arm's length price of wholesale trading and 3% for later any other cases, please understand, the price at which the transaction or specified domestic transaction has actually been undertaken shall be deemed to be the arm's length price. So arm's length price is equal to transaction value. Arm's length price is equal to transaction value, not computed value. I hope you understand this. This is also called as a range concept. So that is, some margin they have given us 3% and 1%. Now next one, where during the course of the proceeding, the AO is of opinion that, AO comes to know that whatever arm's length price computed by you, because in India we are having self-assessment. Self-assessment means you have to give us your transaction value and you only have to give us ALP, arm's length price. Obviously, usually people will not give the true ALP, because they know that if they give the true ALP, they will adopt the ALP. Like if this is your sales, okay, you have sold to related party for 300 rupees and your arm's length price is 800 rupees. So Government of India, definitely they are going to ignore the 300 and they will replace the sales with 800 rupees, isn't it? So that your profit will be increased by 500 rupees. So obviously, if you only give your transaction value and you are only supposed to give the arm's length price, don't you think, my dear friend, if assessee can manipulate the transaction value, then he can also manipulate the arm's length price. And because assessee can possibly manipulate the arm's length price, we are giving power to AO to determine the arm's length price on the basis of material or information or document in his possession. He can also determine in following 4 situations. Price has been charged or paid to international transaction or specified domestic transaction has not been determined in accordance with subsection 1 and 2. So they have not applied the rules. We have these methods, no, comparable uncontrolled price method, resale price method. So they have not applied one of the specified method. Any information or document relating to international transaction or specified transaction has not been kept and maintained by the assessee. So obviously you have to maintain a lot of data according to section 92D, but you have not maintained those data. The data which is used in your calculation is not reliable or not correct, that is inaccurate data. An assessee has failed to furnish a report when it was demanded by the transfer pricing officer or assessing officer within a given period of time. So obviously in all these 4 circumstances, AO may proceed to determine your arm's length price, provided opportunity of being heard is given to the assessee through show cause notice. That show cause notice will come, it will give you opportunity, and in show cause notice it will be mentioned why AO should not determine your arm's length price, because you are not showing the accurate data to the government of India. Now, my dear friend, one thing that you need to know, if this is seller and this is buyer, okay, let us take the Indian scenario first. This is for specified domestic transaction, okay. This is seller and this is buyer, and obviously your associate enterprise. This is your associate enterprise. You have sold goods of 1000 rupees for 500 rupees, okay. Arm's length price of your goods, or let us take here 600 rupees, okay. Arm's length price of your goods is 1000 rupees. You have already sold this particular at 600. Government of India has captured you, or AO has determined this, like this arm's length price is a genuine price in your transaction. So what AO will do? AO will replace this 600 rupees with 1000 rupees, isn't it? When 600 rupees is replaced with 1000 rupees, your profit will go up. I have told you this earlier also, I'm telling you one more time. If your profit goes down because of application of arm's length price, then we will neglect the transfer pricing provision. Transfer pricing provision applies only when profit goes up or loss is reduced. Please understand, that means there is a positive effect from the revenue side. On the revenue collection, more tax will be collected from you. So obviously your profit will be increased by 400. It can be 400 lakh, it can be 400 crore. Okay, don't go on numbers. So 600 replaced by 1000. Now argument of the seller, look at the argument of the seller or argument of the buyer. Sir, okay, you are replacing my 600 rupees with 1000. You are replacing my 600 rupees with 1000. So for my buyer, my associate enterprises, the purchase value was 600. Now that value will also should be increased, no? Because if I have sold goods worth rupees 600, he has purchased goods worth rupees 600. Now you are saying, no, it was not 600, it should be 1000 and you should have taken the 1000 rupees. So you should also replace a purchase price of my associate enterprise and make it 1000. And whenever your associate enterprises, like if they allow to do so, if they allow to change the arm's length price or incorporate arm's length price in the opposite associate enterprises, obviously the profit of opposite enterprises will go down. That means government of India will take the revenue from here and they will lose the revenue from here. Obviously this is completely senseless, and therefore they said no, arm's length price is a one side effect. One side effect means only a books of accounts which is having positive increase effect, only that books of accounts will have adjustment. The opponent, the opposite party, the opposite associate enterprises will not make any changes. We are not going to recompute anything. This is first thing. Secondly, because this unit is eligible for 10AA, this unit here was eligible for 10AA or 80IA, that is profit link deduction. They are eligible for profit link deduction. So what what assessee demanding now? Okay sir, you have increased my 400 by my profit by 400. Please provide me deduction under section 10AA or 80IA in respect of this 400. Again, if we provide you deduction, then what's the point in capturing you and taking a lot of efforts to determine the arm's length price? Many inquiries will happen. It's not that easy to capture this international entities, my dear friend. It's a very big fight. It's government of India versus multinational corporation. It's like a war. And after fighting all the war, if you get the deduction of 400 that we have included here, then again the overall tax collection effect will be nullified or negligence, and therefore what we are saying, no, you will not get any deduction or benefit from this 400 crore. Okay, 400 rupees, that is increase here. Where arm's length price is determined by the AO under section 92C subsection 3, the AO may compute the total income of the assessee having regard to the arm's length price. Okay sir, we will give the arm's length price effect and we will recompute your income. Provided no deduction under 10AA or chapter 6A shall be allowed in respect of the amount of income by which total income of the assessee is enhanced after computation of, please understand, so we will not give you any deduction under chapter 6A heading C or 10AA. That's very simple. Okay, point. Next, provided further that where total income of the associate enterprise, now this is for the assessee in whose books of account, this is for seller from my example. Okay, this two data is for seller. Now this is for buyer. Buyer is saying, okay, you should also change my purchase price because you have changed the selling price at which the goods were sold by my associate enterprises. You should also increase my purchase price. No sir, your purchase price will not be revised. Please understand. Provided the associate enterprise is computed under 92C4, the determination of arm's length price paid to another associate enterprises from which the tax has been deducted or has been deductible under provisions of 17B, that is TDS provision. The income of other associate enterprises shall not be recomputed by reason of such determination of arm's length price in case of the first mentioned enterprise, because your first enterprise was first enterprise income was revised due to the arm's length price application. The opponent computation will not change. Okay, so what government is trying to do? Government is trying to make sure that they are going to recover taxes from these parties who are trying to play with us. So let's start with rule 10B because that's what is more important. Whatever I discussed so far was most of the theoretical concept. This is practical. From rule number 10B onwards, practical thing starts in exam, and more than 60% chances are there. I'm saying with a lot of confidence, more than 60% chances are there. One of the method will come in your exam. Okay, from rule 10B, one of the method will be target in your exam. So if you want to study exam oriented, rule 10B you cannot leave, because these are the 6 methods of computing arm's length price. That is the backbone of whole transfer pricing mechanism. So we are learning the first method. First method is comparable uncontrolled price method. As I told you earlier also, if you are talking about sales, then you are selling goods to your related party or associate enterprise at 100 rupees and you are selling to unrelated party for 300, then 300 is the fair value of your product, right? On purchase side or on expense side, if you are taking some kind of services from associate enterprise, you are paying 1000 rupees to your associate enterprises, whereas you are taking from unrelated service provider. If you are taking services from unrelated service provider, then you are taking it only 300 rupees. Please understand, here you are trying to show more expenses, because obviously you have to manipulate the books of accounts of this associate enterprise. You are trying to show low profit in India. So this is the profit base erosion and profit shifting mechanism. We call it BEPS, and all these methods are actually given by OECD, the Organization for Economic Cooperation and Development, the Organization of Economic Cooperation and Development. In OECD recommendation action plan, all these methods were discussed, and these are the international methods. Don't think that these methods are only applied in India or invented by India. No. It is invented outside India. It was framed, documented outside India, and then India has taken that research, and obviously from that research they have developed their own way through which they apply these methods in India. So the most common method internationally, not only in India, is comparable uncontrolled price method, CUP method. In this rule, uncontrolled transaction means transaction between enterprise and other than associate enterprise. Obviously enterprise and then other than associate enterprise, whether the resident or non-resident. That person can be resident and non-resident, because we have to do some other adjustments also. Let's see. Step 1. What we will do in step 1? Determine the price charged or paid for a property, transport or services provided. So, okay, first compute the price charge. This is actual price for any comparable uncontrolled transaction. Okay. Step 2. Such price then adjust, because lot of adjusting factor has to happen. Like sir, you can say, sir, I am giving my associate enterprises goods at 100 rupees because my associate enterprise is not charging me any advertisement cost. There is no advertisement. It's my associate enterprise. When I'm selling to unrelated party, I have to incur a lot of advertisement expenses. So obviously I'm loading that advertisement expenses cost in the unrelated party transaction. Therefore, I'm charging 300 rupees. See, everybody will try to justify this, isn't it? You will say, sir, associate enterprises is not charging transportation. Transportation is not my responsibility, or they're building it just next to our factory. So we don't have to really incur any transport expenses. So for this unrelated party transaction, there was huge transport expenses. Therefore, out of this gap of 200 rupees, major cost is allocated for transport. You may say, my associate enterprise does not demand any credit period. It pays me immediately. Okay, or there is no concept of payment. There is no concept of receipt of payment. There is no concept of credit. So because my credit concept is not there, obviously my working capital is not blocked. Whereas my unrelated party, they are demanding 3 months credit. So we have to consider interest cost, 3 month in credit cost. Another logic you can tell us, sir, so far as my associate enterprise is concerned, they don't demand any warranty from me. Whatever I sell, they accept. But because this is an unrelated party transaction, they demand warranty from me. So what I'm trying to say, there are various possibilities, quantity discount, cash discount, so many reasons are there for which your uncontrolled price may be higher or lower than your transaction value. So we have to provide some reasonable adjustment. Obviously, adjustments we cannot by heart. Depending upon the question, you have to apply your commercial brain, that whether price should go up because of this transaction or price should go down because of this transaction. So there will be plus adjustment and there will be minus adjustment, that we will discuss as and when we encounter any practical question. Okay. Such price then shall be adjusted on account of difference between international transaction and comparable uncontrolled transaction, which could materially affect the price in the open market that can be made. Whatever we can do, we will do. Next, such adjusted price is the arm's length price. So what we have done, first we have taken comparable uncontrolled price. In that, what we have done, plus adjustment and minus adjustment. That particular after the adjusting, that particular price is the arm's length price. Now arm's length price we will compare with actual price. Okay, price charged or paid in comparable uncontrolled transaction plus or minus this adjustment in difference between international transaction. Okay, this will be your ALP. ALP will be compared with, please understand, ALP will be compared with actual transaction, and then we will see whether there is a positive effect on the profit or not. If there is a positive effect, we will accept it. If there is a negative effect on profit, we will ignore this. Okay, note, normally cup method is applicable when comparable uncontrolled transaction is available. Obviously, when you are doing transactions from India or outside India, there has to be comparable transactions available. Then only you can apply that comparable uncontrolled price method. If you are doing something unique, if you are doing the unique transaction, obviously there won't be any comparable transaction, or you are exclusively doing business with AE, there is no unrelated party transaction, that in that case you cannot apply this method. Yeah, one example we have to learn here. US Limited, this is an important example. US Limited, US company has subsidiary Ind Limited in India. US Limited sells computer monitor to Ind Limited. So this is India and we are buying computers. So you need to understand on which side effect is going to happen. Obviously, the effect is on expenditure side. If they want to manipulate tax in India, you friend tell me, will they try to show higher purchase price or lower purchase price? If they want to manipulate, you think about it. If they want to manipulate prices in India, or if they wanted to manipulate profit in India, obviously they will show the higher purchase price because they are doing the transaction on the cost side of the associate enterprise. Indian entity is the buyer here. Okay. And also sells monitor of 40 CMI Limited. Okay, so there is another company. It sells 50,000 computers, monitors to Ind Limited. So this is a quantity 50,000 at 11,000 per unit. So while selling to their associate enterprise, they are selling at 11,000 per unit. The price fixed for CMI Limited is for 10,000 per unit. If they are selling to unrelated party, okay, unrelated party, they are selling it for 10,000 rupees. You can easily understand here itself that 10,000 should be the fair market value, because when you are doing the transaction with unrelated party, you are showing only 10,000. But when you are doing transaction with related party, in case of related party, you should have done transaction at lower price, but you are doing at higher price. Obviously, your intention has to be base erosion and profit shifting. Try to learn this word, base erosion and profit shifting. That means tax evasion. The warranty case, obviously now you will justify. No, because of warranty we have to do this. So let's see warranty. The warranty in case of sale monitored by Ind Limited is handled by Ind Limited. Okay, so warranty will be handled by Ind Limited only. However, for sale of monitor by CMI Limited, US Limited is responsible for the warranty for 3 months. Acha. So they are not only, please understand, they are not only giving this computer at 10,000, they are also providing 3 months warranty. Obviously, if they are providing 3 months warranty, then you should have charged more price from them. We are taking without warranty, so you should have taken less price from us, isn't it? With warranty, more price. Without warranty, less price. You can check on Amazon or Flipkart now. Product with warranty are costlier than product without warranty, or product with 3 years warranty are more costlier than product with 1 year warranty. So warranty obviously is the cost to the seller. Here the seller is not, the associate enterprises is not even demanding the warranty, but still you are charging 11,000. So that is completely unfair. So we have to again check. We have to again check the warranty effect also. If you are going to compare both the transaction, what if the warranty was charged by associate enterprise? Then what would have been the price? That you have to check. Okay. Both US Limited and Ind Limited offers the extended warranty at the standard rate of 1,000 per annum. Okay, so that is 1,000 per annum, the warranty. But now here they are playing with you the numbers per annum, whereas here warranty was 3 months, isn't it? So you have to provide a time factor, 1,000 rupees per annum. If you have to convert it into 3 month data, then you have to multiply by 3, divide by 12. So that is simple adjustment that they were trying to play with us, that they have provided us adjustment factor, but they have provided adjustment factor in an annual term, whereas it is applicable in 3 months term. So obviously you know how to do proportionate. On this fact, how is the assessment of Ind Limited is going to affect? Look at this. Whenever you answer transfer pricing provisions question or question on 92C, first you have to give answer to 92A. What is 92A? How does these people are associate enterprises? US Limited is a foreign company and Ind Limited, the Indian company, are associate enterprises, since US Limited is a holding company of Ind Limited. Holding company means obviously more than 50%. US Limited sells computer monitor to Ind Limited for resale in India. US Limited also sells identical monitors to CMI Limited, which is not an associate enterprise, which is unrelated party. The price charged by US Limited is similar for the similar product transferred is comparable uncontrolled transaction. So obviously CUP method is applicable because the most relevant data, according to the data, most understandable concept is comparable uncontrolled price method. Therefore, comparable uncontrolled price method for determining arm's length price can be applied. For sale of monitors by CMI Limited, US Limited is responsible for warranty of 3 months. The price charged by US Limited to CMI Limited to include the charges for warranty of 3 months. Hence, the arm's length price for the computer monitor sold by Ind Limited would be, this is how you will compute, learn the computational mechanism. First time you are doing this, you should do it at your own at least 2 or 3 times to fix it in your mind. How do we provide the adjustment? So right now, you are not only learning the comparable uncontrolled price method, with that you are also learning how to give warranty effect. Okay. Obviously, the base price is 10,000. I have told you, first step you have to take the comparable uncontrolled price method. Second step you have to do plus or minus adjustment. Obviously here we have to do the minus adjustment because this 10,000 is inclusive of warranty. We have to make it exclusive of warranty. If I exclude the warranty, my price will go down. Okay. So cost of warranty included in the price charge, 1000 into 3 by 12. So that will be 250. So the fair price, the arm's length price after the adjustment is 9750, whereas I have done the transaction at 11,000. Now think here, before going forward, think here. This is my P&L debit side. You are showing the purchase price 11,000. If they change this 11,000 price with 9750, what will be the effect on my profit? What will be effect on my profit? Will the profit go up? Definitely, sir, profit will go up, and therefore the effect of transfer pricing mechanism, please understand, the effect of transfer pricing mechanism will be provided. The per unit difference is 1250, and if you remember, they have provided the effect for 50,000 quantity. So you have to apply it on 50,000 quantity. 50,000 quantity if you apply, the total addition that is going to happen, is 6 crore 25 lakh in the hands of Indian company. Now my second question here, very important question. Because you are reducing the purchase price of Indian associate enterprise, will you reduce or will they allow to reduce the sale price of associate enterprise in USA, do you think their selling price will be subtracted in their country? Definitely no. No, this is not going to happen. Okay, because we are increasing here, that doesn't mean the counter effect has to be given there. Counter effect will never be given. That's what transfer pricing mechanism, computational mechanism 92C says. Thank you.